What is market risk? Market risk arises from adverse movement in market prices, including equity prices, things like the stock exchange, or even privately quoted shares and so on. But it's about the price and the movement against or conversely to what is expected or the positions that have been taken by the financial institution. Interest rates also move. Interest rate changes are going on, always go on by central banks, and there are different types of interest rates. But interest rate moves that are contrary or that give or leave a negative impact on your positions as a financial institution. Foreign exchange rates and commodity prices as well. Unlike credit risk, which focuses on default probability, market risk concerns the volatility and correlation of asset values. Financial institutions face market risk through their trading books. Now, financial institutions have to trade. They also through their investment portfolios and structured positions. A bank's bond holding lose value when interest rates rise. An example, if the central bank interest rates rise, or sometimes called the base rate, then and the bank's bond, which is tied to a particular rate at the time it was purchased, every time if it rises, the bond holdings that they are holding will lose value. And investment fund suffers when equity markets decline. So investment funds are there to grow equity portfolios, and where the equity prices decline, could it be an indication that there's a problem in the market? Could it be a long-term sustained thing? Is it a problem of liquidity? What is the problem? Are there big players that are running into trouble and so on? So those decline, and that's a market risk that needs to be considered and hedged or mitigated. Currency mismatches create exposure for international operations, where there's too much exposure to certain currencies, especially the currencies um, are not stable, or the currencies have a history of not being stable.